the Real Estate Coffee Break. Our 5-minute podcast intended to give you kind of a quick download of information while you're waiting for that cup of Keurig to brew. I'm your host, Collin Chlebak, and I lead Vertis's national real estate practice. We're headquartered in Kansas City and have offices across the country and insure over 300,000 units in the multifamily arena. Today's guest is Mark Allen of Greystone. Mark, thanks for joining us.
Yeah, thanks, Colin. Happy to be here.
Yeah. Well, if you would just give our listeners just a brief intro of yourself and what you do for Greystone.
Yeah, so I was telling Colton prior to hopping on or starting the recording, and I think before you hopped on, that don't be jealous. I'm sitting by the beach here in Belize at my beach house. So if you hear waves crashing in the background, just kidding. I'm in my home office, and if you hear babies crying or vacuum cleaners or microwaves beeping, I apologize in advance. But Mark Allen with Greystone. I am an executive managing director in the Dallas-Fort Worth office. And we have Greystone is a private company based out of New York, primarily known as Fannie Freddie direct underwriter and servicer. So we're a lender, but also, we offer bridge loans and as well as HUD loans. We're the number one HUD lender in the country. So that's our roots. And through that, we've been expanding the investment sales platform across the country in major markets. From Atlanta, I think was one of the first. We have our affordable team based out of Florida. Then we would cover all the major Texas metros with Dallas, Houston, and Austin. Continuing to grow. I think we just added a team in Philadelphia that covers the tri-state area, large team there. They do over $1 billion in sales a year, and looking to still grow in some major markets like Phoenix, Orlando, and some others across the country. So very fast growing company. And again, our Dallas office, I am part of the investment sales platform. And we specifically, all we do at Greystone is multifamily. So that could be, market rate, conventional housing. It could be student housing, affordable housing, any kind of assisted living facilities as well we lend on. But we say we're an inch wide and a mile deep. So all we do is multifamily. And I specifically focus in Class B and C multifamily, so workforce housing in the Dallas-Fort Worth Metroplex.
Awesome. Well, that is certainly kind of our bread and butter at Vertis as well. So some good synergy between us, in the habitational space, and then specifically that DC workforce housing, value add properties are probably 65 to 75% of what we insure. So good synergy there. I'm interested, looking at what's going on in the world. You say you're working from your home office and babies crying and vacuum. I mean, it's something that we're all dealing with across the country, it seems like. And how has that changed what's going on in investment sales for multifamily there in Dallas-Fort Worth?
So, everyone knows coronavirus has been rapidly spreading. It seems like it's maybe or hopefully curtailing off now. But with less travel and school and less business, obviously, we'll see retail, hotels, student housing, and office space affected. But at the end of the day, people need a place to live. And I see multifamily will remain as one of the safest asset classes in commercial real estate because of that fact. So it seems like today, at least I'm tracking that the government, despite some politicians trying to push their personal agendas, looking to help Americans and our business. So the Senate has approved a $2 trillion bailout or stimulus package to aid in keeping us afloat while, this virus, hopefully with some of the social distancing, is curtailed. But as far as investment sales, we're seeing the credit market tightening up a little bit. Bridge lenders, many have fallen to the wayside. And they're either not lending or they're adjusting their terms. And when I say adjusting terms, we're seeing them holding more reserves in escrow. They're also decreasing. They want to see, the owners put a little more skin in the game. have a little more equity in there. So decreasing their leverage, and also some of them increasing their debt service coverage ratio. So same thing with Fannie right now too. Fannie Mae, we're seeing interest rate spreads increase. So we saw rates, last week jump from, even on Friday, I think they were in the high 3% range, and now they're in the high 4s. So interest rate spreads have increased for Fannie Mae as well as the reserves. They're requiring both principal and interest reserves along with taxes and insurance escrow. 6 months for lower leverage deals and 12 months for higher leverage deals. So happy to get into the details there. But Freddie Mac is still probably about a 70, 80, 90 basis point difference in rates. So we are actually still seeing Freddie Mac in the high 3s, which is positive. And they're not requiring any reserves at this point. Although, that could change in the coming weeks, that they will likely follow suit if things don't pick up here. Evictions and foreclosures were halted. That's positive, or, well, I don't know if it's positive news, but basically it's their lenders are offering forbearance where the borrower can suspend, if they suspend evictions, they're basically being financially impacted by COVID-19 for the longer of 90 days after the forbearance agreement effective date, or until the mortgage is brought current. So the lenders are providing some help for the landlords, which is positive as well. But I would say all in all, many investors are kind of like in a wait and see mode. They want to see how April rent collections shake out. I mean, that's going to be the telltale sign, because, property values today are going to be a heck of a lot different. If, they're collecting, let's say, 100,000 in net rental collections today, and April 10th are at like 60,000 and don't expect to collect much more. So that's going to affect the loan that you could put on the property as well as the value. So I think most are in a wait and see mode.
Yeah, so that's interesting, right? And as Freddie and Fannie, start these forbearance programs, you on the front lines of selling something for these owners and help identify deals for folks. Is that playing into the rent collection playing into it? Are you I would assume that interested buyers are wanting to know how many of the current tenants are always current on their rent, but even now in this kind of uncertainty that we're in, is that even playing a bigger role in people's decision making?
Yeah, absolutely. I mean, not even just with the buyers, with the sellers. I have sellers that are like, I signed listing agreements a couple weeks ago, and we're about to come to the market, and they decided to put on hold. They're like, hey, I don't want to get into a contract where, I'm kind of set up for retrades, where someone's asking for price credits, and the deal is just falling apart, and I've wasted, legal fees, and so there's some costs involved, there's some time involved. So it seems like most sellers are just kind of putting pause as well. But yeah, most definitely. I mean, it's going to affect valuations if properties are collecting less rents.
Yeah. Well, I appreciate, we're trying to keep this thing tight, and I really appreciate you being on here today. Do you have any parting words of, as being an expert in the multifamily industry there in Dallas, Fort Worth, what's your advice to clients right now? I mean, as you said, a lot of people are on the sidelines waiting and seeing. With that approach, is there anything that you'd like to add?
Yeah, I believe in holding multifamily and supply constrained areas over the long term. So I'm a firm believer in multifamily, especially in good locations that are fast growing. So it may be a great time for buyers to take advantage of a lull by getting better deals before the market picks back up, and there's 10x more competition. For owners, I guess my advice would be you should be stress testing your portfolios with various scenarios. Cease rent increases. You only make emergency repairs. So you want to be holding cash at this point. Be transparent with your investors and your lender if you're a syndicator. Don't neglect your property or your debtors. Continue to pay your taxes, insurance, and other bills, because that, at least my understanding, I wasn't around then, but I heard that hurt some owners that just kind of neglected their property whenever it came time and they weren't paying their mortgage bill.
Yeah.
And then for those who plan to sell or refinance later this year, the market will return to normal soon. So as the national, call it economic sentiment, improves and lending loosens a bit, we'll likely see a frenzy of buying activity as this picks back up. So, I'm unsure what treasury yields will do and interest rate spreads will do for those that plan to refinance, but there is light at the end of the tunnel and it will return.
Great. Well, we appreciate that insight today. That's our coffee break. Mark, we appreciate you being on. And I'm sure if anybody has any questions, please reach out to Mark. We'll have his contact information posted on here. And I would assume that you'd love to have some conversations with potential sellers. Is that right?
That's right. Yeah, I would love to talk with anyone buying or selling or refinancing and figure out how we can help or advise.
All right. Well, thank you very much. Appreciate it.
Yeah, thanks, Collin.